Welcome to the LA Real Estate Podcast on buying and selling real estate in Los Angeles. Joining me on the show today again is Dave Robles from Think Real Estate. Today we'll be talking about different strategies for marketing your home. And later I'll be speaking with Justin Bayle from the LendLA Team, and we're talking all about mortgages and financing. Dave, welcome back. Thanks for coming back. This is amazing.
My pleasure, Sara. I'm so glad to be here. It was so much fun last time, and I get to do it again.
Dave and I were at the same brokerage for about 5 years, and recently you made a shift. So tell me about your new brokerage.
We moved Think Real Estate Group to a brokerage called EXP Realty, which is quickly becoming a major player in the country and now in Los Angeles. But it's a totally different approach to brokerage as a cloud-based brokerage versus a brick-and-mortar brokerage. So it's pretty interesting. We're seeing real estate change quite a bit right now, Sara, and I think EXP is kind of a way that it is changing for agents and brokers.
Things have shifted a lot. I mean, so much more is online now. I can't remember the last time I went in the office because most of my business is in my car, driving to and from appointments, or at home, rushing to get things together before I go to appointments.
Well, 27 years ago when I got into this business, I had to go to the office because my phone was there. I didn't have a cell phone.
Right.
Eventually, my desktop computer was there, and my files were all there because we had paper files. And today, all of that's been replaced with an iPhone.
Oh, that's so funny. I didn't even think about filing cabinets.
Oh, yeah.
Because everything we do now is paperless for the most part.
No, every transaction had a file that was 2 inches thick. It was crazy.
Wow. Think of how much paper we're saving.
So much.
Okay, strategies when listing a home. Now we're rolling into the end of the year. We're right before the holidays. So what do you think, Dave? If somebody came to you today and said, hey, Dave, I'm thinking about selling my house, would you say, yeah, let's go ahead and do it? Or would you tell them to wait until next year?
Kind of case by case. I have a client that we're going to be putting their house on the market probably right before Thanksgiving, maybe like the week or so before. The house is vacant and it's staged. So we don't have to worry about Christmas decorations or holidays and stuff like that. Now, if you're a big holiday person and if having a tree up and lights and all that decorating is really important to your family, you probably want to wait till January.
And actually, that's a really good point because a lot of people have time off work during the holidays and they're home more. So having a whole bunch of people in and out of your house is going to be very inconvenient.
Totally. Cleaning up, and it's a big deal. The other thing to consider that people don't is that sometimes I'll get clients say, well, okay, we want to hit the market January 2nd. Okay, well, think about the logistics of that. If you decorate for the holidays, we can't shoot your house while it's decorated.
Right.
So we have to actually shoot your house probably in November.
Wow.
So that you can enjoy your holidays in December, and then we hit the ground running on January 2nd.
And something I feel like a lot of sellers don't think about is when they say ready to go, there's still lead time that's needed before the house actually goes on the market, especially if it needs to be staged. If it needs, obviously the photography is very important. And then if we're doing marketing material, we need a few days to print and to order and to have everything in its place. I usually like to have 2 weeks
I agree.
From when the house is fully ready. Like, hey, okay, we're ready to stage, we're ready to go. Although longer is better, and I have done it in much shorter, but it's a stressful process for the sellers when you're rushing them to get everything done, especially when you think about you're going to need at least 2 days just for cleaning. Yeah,
there's a lot to consider. There's a lot of moving parts. And I know as a listing agent, when I have the right amount of time, everything just is easier and better, and the seller ends up with more money. When you rush to the market and you're throwing the house on the MLS, it's never the right approach.
I always think, too, I think about the open houses a lot because LA is an interesting city. For example, when Burning Man is happening, a lot of younger buyers are out of town, or Coachella. A lot of people are gone, or long weekends. So if I know, say it's going to be a Labor Day weekend, then I maybe would wait a week before putting the first open house on. So I feel like being a little strategic about listing is important.
You're absolutely right. You know, LA is unique. I have a lot of real estate friends around the country, and open houses are not a thing in other places.
Right.
But in LA, especially in like the Northeast LA area, open houses are really important. It's almost a pastime. People, buyers, they like to be in control of their search. They would prefer to go to the open house and see the home on their own terms rather than book an appointment and go on a Wednesday at 2:00. It's just how they operate.
I feel like a lot of my clients are creatives, so they don't have a predictable schedule. So they'll say to me, oh, you know what? Okay, well, you've sent us a couple houses. That's awesome. If you can I text you 20 minutes before we're about to go see it? And if you can make it to the open house with us, great. And if you can't, no worries, we'll go back and see it again. So, you know, and obviously as realtors, our weekends are incredibly busy. So if I have multiple clients that want to see houses on Saturdays and on Sundays, I do have a buyer's agent that helps with showings. But often they'll kind of be having lunch and then, pop by an open house on the way home. And what I say to all of my clients is, if you want to see it on your own at an open house, that's great. However, if you like it enough, you're considering placing an offer, call me right away. We'll go back and see it together. Firstly, it's great because I want to see it and give my opinion. But secondly, it's important for somebody to see a house more than one time before they buy it, I feel like.
Proof that you're a great realtor, Sara.
Oh, shucks.
Seriously, I can't tell you how many offers I get where the buyer came to the open house, yet the realtor sends in the offer and never saw it.
Right.
How can you counsel your client on the whole offer procedure if you haven't seen the house yourself?
Also why it's important to use a local realtor. You know, we live in LA, so if your realtor lives in Santa Monica and you're buying on the east side, the chance that they're going to be able to just pop on over and see it while you're there is slimmer. So I firmly believe in using local agents.
100%.
And there's a lot of good local agents in this area. I mean, we're both friends with so many agents, so many good agents.
Yeah, I have a litmus test for that. I think as a realtor, if you look at an address and can't decide based on the address if it's priced decently, then you probably shouldn't be working in that market.
Oh, interesting. I think that's a really good point.
You know, I've benefited from an out-of-area agent selling a listing of mine and paying way too much. Mm-hmm. And I just say thank you very much from my seller.
That's true, actually.
You know, because you didn't know.
Yeah, or people don't do the research on different parts of the area. So someone, for example, that's not familiar with the difference between Cypress Park versus Mount Washington, and why are Mount Washington prices higher? Because of Mount Washington Elementary School District. Right. So if somebody isn't familiar with that and there's a house in Cypress Park and they say, only, you know, a couple blocks away, a house sold for this much more, you should throw money at this. So it's important for not overpaying. And then also, you know, if you're listing a house and you're a local agent, you have relationships with other agents. I know that there are certain agents that I'll just go to their open houses because they're my friends and I want to support them. And then I'll go to the open house and say, actually, this house would be perfect for one of my clients. So, you know, it's important to have these relationships and to work with a realtor that has these relationships.
Firmly agree.
Another thing I wanted to ask you about, obviously, so listing at this time of year is case by case. Obviously, also, if you're in a position where you can't wait, for example, you have a job relocation or there's a big reason you need the money for a reason and you have to sell, we are still in a very seller's heavy market. I've put out plenty of offers in the last 3 weeks. I don't think a single offer that I wrote for clients didn't have at least one other offer.
Right.
So it's still a very seller's heavy market right now.
And I think that is specific to the areas that we work in. Again, I have friends outside of LA and it's crickets down in Orange County and some parts of Orange County.
And I know the West Side as well. West Hollywood, for some reason, I have some friends that work in that area. And I know the condos are sitting a little bit. If they're not priced really low. Another trend, which I'm sure you see in our area, is underpricing. So there's some agents there's different strategies to pricing. There's some agents that will price a tiny bit under what they think market is. Sometimes people will just price high, hoping that they get the one person that will pay that. But there's a lot of agents that price way low. They know maybe 100, 150,000 below at what they think it's going to close at, expecting multiple offers.
Right.
So what are your feelings on pricing?
Well, there's, to me, three types of prices. There's the aspirational price, which is higher, and then knowing, as long as the seller knows, you're probably not going to get it and you're going to have to reduce. And then there's pricing it right where it belongs, market pricing. And then there's the lower, what we call event pricing, which is to generate interest and bring hopefully multiple offers. But how much is too much? I mean, 20% is way too low.
Right.
That's not correct. That's just
right.
the wrong thing to do. But coming below maybe 5-7% below what market value is, sure, that's legitimate. And overpricing it, again, 10% is too much.
Right.
5%, that's doable.
What's funny is I have had listings that I thought were priced just a little below what they would close at based on the comps. And then crazy amounts of interest, and all of a sudden you are way, way, way above. It's great for the sellers, obviously, but way above what you expected to close at. So it's really unpredictable. If two people love a house, sometimes they can get bid way up.
That's all it takes.
I see that a lot with mid-centuries, too.
Yeah.
People become obsessed with them.
Have you ever listed a house that you thought was priced right and it got crickets?
I kind of think. You know what? I had a duplex once that I thought I'd priced really well, and it took 3 weeks before we got an offer. And we ended up getting a really good offer, but I was really surprised it took that long.
We just sold a house in Glassell Park on Yorkshire.
I know exactly
you know
which
the
house.
I know
which house.
We thought we nailed the price, right? $999. And it took us 2 months to sell it. And you know why?
Why?
Here's what we think. The master bedroom was downstairs, and the other two bedrooms were upstairs. And families did not dig that.
Yeah, I could understand that.
Yeah.
I could understand that.
And then also the neighbor was kind of Sanford and Son. So together, those two things were enough to, we sold it and the seller got the price they wanted, but it just took time.
Right. And it's so funny because in the rest of the country, people would be mocking us that 3 weeks is a long time to sell a house.
Yeah, right? Yeah, I know.
I know New York right now, the luxury market in New York, there's been so much building that things are sitting. And average days on the market in luxury is, I think, 6 to 12 months right now in New York.
Get comfortable,
right.
man. Jeez.
So 3 weeks is pretty funny. But I haven't, I did have a crazy listing once. And the gentleman that owned it had passed away in the house. And it was full of stuff. And that was tricky because it was really hard to sell with so much stuff. I didn't even want to take photos, mostly because there were boxes and boxes and boxes and boxes of pornography. It was the most bizarre thing ever, but it was just a little disturbing. There was empty bullet boxes. It was a strange listing. Yeah, it was a probate. Anyways, I sold it. I sold it to a flipper who ended up, they still haven't put it back on the market though. So I don't know the story behind it, but it's really interesting. Every time I drive by, it's in Glassell Park.
Okay.
Every time I drive by, I see them doing a little bit of work. So I think what's happened is someone bought it. They're living in the house while they fix it up. One day at a time. Yeah,
right. Well, let's see what they list it for.
We see a lot of things in this industry.
Oh, my God.
See a lot of things. All right, Dave. Well, thank you again for being on the show. It's so great to have you. And if you want to check out Dave's company and answer any questions, you've always been so incredibly helpful when I first started, how much information you were willing to share with me to make me a better agent. And I'll always be eternally grateful for that. So thank you so much, Dave. And thanks for coming on the show. Here's a seller's tip. Read the reviews on the agent you're planning to use. If you're planning to use me, you can go on Yelp, you can go on my website, and you can see reviews from hopefully happy, satisfied customers. But if you're using a realtor, check the online reviews. I have a very special guest today, Justin Bayle from the LendLA Team. Yay!
Hey, Sara. Thanks for having me.
Thanks for coming into the studio. I'm so excited to have you here because nothing gets me happier than hearing about low mortgage rates.
That and clear to close, right? That's what
clear
you want
to
to
close,
hear.
Yeah, no. Or closed. We're officially closed. The house is sold.
Absolutely. I
So
think we have
tell
one
me-
funding today.
Yeah, we do actually. We have a deal that we're closing or funding today, and we'll close tomorrow. We're actually waiting for the call right now. So, of course, as a realtor, I work with all kinds of different mortgage brokers, and often people will ask me, who should I use? And I like to recommend people I've worked with before, and we've had great deals together. It's been really easy and seamless.
Well, great. I appreciate that. I counsel my clients on who they should use for their mortgage as well. And yes, I want them to choose me. But at the end of the day, it's a very big financial commitment. It's a lot of money on the line. And right. I always tell them before you shop for rate and all of this stuff, like, who do you trust? Who do you feel comfortable with? Who do you think has your best interests at heart? Because that's the person you want to work with.
Right.
Rates come and go.
Something that I always try and tell my clients is, you get all these teaser rates, or somebody will tell you, I can lock you in at this. This is what mortgage rate I can give you. Mortgage rates change multiple times a day, and nobody can commit to giving you a rate until you're ready to lock in. So really, when do people normally lock in? Would you say halfway through escrow?
It varies by the client. I keep a pretty good tab on what's happening in the mortgage-backed security market, and I'm watching it every day so I can provide good advice on when to lock. But you can't lock generally unless you have an accepted offer in a contract.
Right.
So, there's lots of people who want to shop around. It's a very tough position for the consumer because before you're under contract, it's too soon to shop around for the best rate. And as soon as you're under contract, it's too late. Because right? Because you have contingencies, and somebody needs to get moving on all this stuff because the listing agent or the seller or somebody's going to ask about it and say, "Where's my appraisal?" and when are we removing our loan contingency and all of that stuff. So it's a tough position, which is why I advise the client, who do you trust?
Right.
Who's actually going to have your best interest at heart and give you, solid advice? Work with that person. If you try and time the market, it's like anything. If I go and buy Apple stock today and it's $200 a share, and then tomorrow it's $198 a share, and I'm like, shoot, I should have bought it for $198. Right. That doesn't mean I made a bad investment at $200.
Exactly. And our rates, I just can't even believe that they are still this low. A few years ago, so when I bought my house in 2009, or 2008, sorry, I got a rate at just under 7%. And people were telling me, wow, that's a great rate. Good for you. How exciting. I can't believe you locked in under 7%. Now, was the house a lot less expensive? Yes. But what's crazy is over the years, obviously, when rates went down, I refinanced. So I was able to go into a 20-year loan and get my house paid. My mortgage rate went way down, and my payment is insanely low because rates are so crazy low. And people always focus on the price of the house. But really what's important is what are you paying every month? Because that's the true cost of your house.
Absolutely. Not
the purchase price, but the rate.
Yeah, and we're in a unique market here where, the majority of your investment appreciation comes as the house increases in value, not necessarily in you paying down the principal balance of your mortgage. You're not gaining equity that way as fast as you are, knock on wood that the market continues or even stays steady.
Well, our big thing here is lack of inventory. And it's not like there's thousands and thousands and thousands of houses being built. So, in pockets of LA where we just do not have enough houses, house prices stay pretty solid. Especially when you're looking, if you're in a good school district, those houses hold value. That's why I'm really proud to be in Northeast LA. I love our area, and I think the prices are going to continue to rise. So tell me, what is going on with mortgage rates right now? Because I'm actually a little out of the loop. I've been so busy. I like to keep abreast of what's happening in the mortgage world, but I'm kind of out of the loop right now.
Sure. So this summer, we saw a huge swing down in rates, which was fantastic. A lot of people got to take advantage of it. Now, as we've moved into the fall, the Chinese trade deal has put a little bit of a damper on that, and rates have started to move up. Today, in particular, is a very, very bad day. Rates are probably, an eighth to a quarter point higher than they were yesterday, or they were on Friday.
Wow.
Yeah, so that's significant. But again, my counseling to my clients is, if a quarter point interest rate makes or breaks whether you're going to purchase the home, you're in the wrong price point.
Right.
You need to move down in price point because you're clearly not comfortable with it.
Right. And rates tend to jump up a lot faster than they go down. Is that correct?
Yeah. It's definitely, an escalator up and an elevator down. Or no, the other way around. It is definitely an elevator up. They move up really quickly, but it's an escalator down.
That makes a lot of sense. So are you seeing, now I've talked about this before. I'm a bit conservative when it comes to finances. So I always wanted, I locked in at a 30-year fixed because I knew that no matter what happens, there's a good chance, even if I ended up moving, say, out of California, I would still hold on to the house, potentially rent it out. My mortgage payment was already so low. So I locked in with 30-year fixed. What percentage of people would you say are going for 30-year fixed and who are going for adjustables? The
vast majority of people are going with a 30-year fixed. The argument could be made that that's a mistake. An actuary will tell you that it's highly unlikely that you will have your mortgage more than 7 years.
Right.
You are going to refinance, you're going to sell, you're going to move, you're going to do something in 7 years. You're going to refinance, pull out money. It's something is going to happen.
Right.
With that said, it's what makes people feel comfortable.
I think you should just always know worst case scenario.
Right.
So, for example, if you say, there's a chance I might be selling in 5 to 7 years, so I'll get a 10-year adjustable rate loan. Worst case scenario, in 7 years, if, say, you lose your job or you get sick or something happens, are you still going to be able to make your payment if it does adjust to the maximum amount?
Right.
Or do you have safety nets, like family maybe, that could help you out?
Yeah, absolutely. And you have to look at the bigger economic picture, too, when it comes to those adjustable rate mortgages, because if the rate were to adjust to the absolute maximum, generally on ARMs, it's 5% above wherever you started. So let's say you got an ARM for 3%, and 7 years from now you wake up and it's 8%. If that's where the index is, that means the overall economy has seen tremendous inflation. The house that you paid $750,000 for is probably worth $1.5 million. So there's a whole other exit strategy if it's really that dire.
Right.
It's probably not that dire. Also, your $125,000 a year salary at whatever company you're working for is probably now $225,000 because that's what the economy is bearing and that's what inflation has done. So that's a difficult concept, I feel like, for a lot of consumers to understand.
It sounds like it's actually a hard choice then for people. I guess for me, I'd always be conservative. I'd rather pay a little bit more, but have the safety of knowing that I always have, that payment.
It's difficult to trust.
Right.
It's difficult to trust.
And then now tell me a little bit about, so at 2008, when the housing market crashed and everything happened, people like me, I was still able actually to get a stated income loan. Mm-hmm. It was right before those loans went away. And I didn't really have to provide very much. I mean, I was a nanny and a personal assistant and a drummer. So I didn't have a lot of income on paper, but I was able to get my loan. And then I know things tightened up a lot. So where are we now with regulations? How hard is it for someone to get a loan that has, let's say a industry job that's a little inconsistent or people that don't have great credit? How is that looking? Sure.
We moved to a market now where we have two types of loans basically for owner-occupied properties. What's called a qualified mortgage, a QM, or a non-qualified qualified mortgage, a non-QM loan. So you'll hear this term non-QM quite a bit. The market for non-QM loans is expanding. Basically what that means is that the mortgage is not compliant with what the government has decided protects the lender from being litigated by the person they lended money to. So let's say I give you a mortgage and I don't fit you in the box, and then 5 years from now you default, you have a problem, and then you want to come back to me and say you should have never given me that mortgage. If you have a non-QM, you can sue me as the lender and say you should have never given me that mortgage to begin with.
Wow.
If you have a qualified mortgage, a QM loan, which is the majority of loans, it's Fannie Mae, Freddie Mac, FHA, most jumbo investors, they all fit into this QM bucket. When you signed your loan documents, you signed away your right to sue me over lending you the money.
Okay.
So that's really what the difference is. The non-QM market is expanding extremely rapidly. The investors and lenders have decided that they want to take on the risk.
So those are riskier loans. So for example, someone maybe with really bad credit or someone that doesn't have a stable income?
What we're seeing mostly is that their income is not documentable in a traditional fashion. So they might have great credit, but we might have to show 12 months of bank statements to show what their cash flow is. Okay, you're a drummer in a band and you're getting all of this money, but then you're writing a bunch of stuff off, and it's not,
and your
it's not
savings
reflecting.
account is suitcases under your bed full of cash and Bitcoin.
Well, that's
chips.
that's the other non-QM loan that I'm actually, I just recently closed a transaction for. Actually, he was in a band, but he had put a bunch of money into Bitcoin at the right time and then sold at the right time. And so he was sitting on millions of dollars.
Wow.
And we did what's called an asset depletion, where we said, okay, if you withdrew all of this money that you have in the bank over the course of 7 years, here's how much you could take out every month, and you would have the money for 7 years. That's what your income is. And then I don't care what your tax returns say.
Are those loans that I would assume would have a higher interest rate?
Correct.
Coming up, I'm going to have a little bit more with Justin Bayle. But first, here is a seller's tip. As a seller, it is very important to have multiple sets of the keys for your house. If you have a little shed, if you have a crawl space, make sure you find the key for those locks and label them and have multiple sets so that you can give one to your agent. And it's also much easier for the buyers when you hand them keys and they're actually labeled and they know where they go to. Funny story, I actually had a client who told me, and I adore my client, he was the sweetest guy ever, but he's like, we actually don't use a key to our front door. We don't lock it. We just go in and out.
This is my in-laws in the suburbs of Chicago. They never lock their door. I'm astounded by it.
I'm like, how do I show your house if you don't have a key? I mean, I can't just keep the door open.
Right.
I love it. I love it. All right. Let's talk a little bit more about mortgages and financing. So we have obviously, buyers and sellers listen to the podcast. What I'm getting a lot now is people that are in a home and they want to move up. So they want to sell their home and buy at the same time. What types of financing is available for those clients?
There's a couple of options. And they need to be speaking with a mortgage professional as soon as they come to the conclusion that they're probably going to step up so that they can get all of their options. A major one would be, is there a bunch of equity in your home and we can get you a home equity line of credit and use that as the down payment on the next house? Can you qualify to carry both mortgages at the same time? If you can't, there are options where we can exclude the debt from your departing residence as long as it's actively listed for sale and the underwriter can verify that.
What do you mean by exclude the debt? So
when we're calculating your debt to income ratio, we're looking at all of your debt obligations. Do you have a mortgage? Do you have a car loan or lease? Do you have some credit cards? Do you have some student loans? All of that. And do you then meet the debt to income ratio threshold, generally 43%? Okay. Now, of course, if you're adding another, and then we have to include whatever new mortgage you're going to get. So if you're buying a new home and now you're going to take out another loan for $500,000, we have to add that into the mix as well and still make sure you meet that threshold. what we can do is exclude that departing residence, meaning, you owe $2,000 a month on the home that you're going to sell. Is that property actively listed for sale? Can we verify that? Is it in the MLS? Is it out there in the public? Do you have an additional 6 months of reserves in the bank that shows that you could pay that for the next 6 months? Then we can exclude it, and we don't have to add it into your debt to income ratio.
That's interesting.
Yeah.
So what do you think? Because say for someone like me, I own my house. I have a really good amount of equity in the house. I'd love to buy an investment property. Would it make more sense to refinance my mortgage now, which the balance is very, very low, to get money? Or do you think it makes more sense to pull the equity mortgage, or what would you call it? Equity loan?
A home equity line of credit.
Line of credit.
Right. So it works like a credit card where you only pay for whatever you draw.
Oh, okay.
So if the money's earmarked and you're 100% sure you're going to use it, it makes much more sense to do a cash out refinance and take the money. If your loan balance is only $150,000 now and you want $200,000, you're going to have a new loan for $350,000. As long as you're going to spend the $200,000 and you're sure of it,
okay,
then the rate will be better. Long term, it will make more sense to do the cash out refinance and lock it in and know what you're going to pay. If you're wavering, you're not sure, maybe I'll spend the money, maybe I won't, then the line of credit makes more sense because you don't have to pay anything on it on a monthly basis if you don't draw anything.
That's actually really smart because you don't access it until you actually need it.
And it's like having a credit card with $10,000 balance. Well, if I only spend $1,000, maybe I'm only paying interest on $1,000. I'm not paying interest on $10,000.
And how long? So if you do have the equity line of credit, say it takes 3 months to find the house you want to buy. From the time you say, okay, I need the money to when you get the money, how long is that?
Most line of credits, it's pretty much immediate.
Really?
Oh, yeah. Like when you get the line of credit, they'll generally give you a checkbook or a debit card. You can do a transfer online. I have my own personal line of credit at my home with Boston Private, and I have a checking account at Boston Private. Well, I can go online, and if I want to just transfer $100,000 off of this line of credit into my checking account, I can do that, and it happens instantly.
That's incredible.
Yeah.
So then I would expect that to make your offer very competitive because it's basically like buying in cash.
Absolutely.
So writing an offer. Yeah, because that's something my husband and I are considering. It's time, I think, to move some of the money. I don't want to put it in the stock market because I'm nervous about what's going to happen with the stock market next year. And obviously, with what I do, it's like put your money where your mouth is. You're telling us to buy, then buy.
100% invest in what you know. I feel the exact same way. I buy real estate because I understand real estate and I know real estate.
Right.
I don't know what's happening in the stock market.
Yeah, and I just feel the stock market is so volatile and again, it's high. So everything with everyone, any experts like, don't buy high. Buy when it's low, sell when it's high.
We got to be careful with that, though, because the argument could be made about real estate.
Right. Well, the only thing that's different, though, I think about real estate is really, yes, maybe the house prices are high, but the interest rates are incredibly low.
Yes. So if you're leveraging.
Right.
And that's the other thing about buying real estate that I'm always in favor of is that you get to leverage. You don't get to leverage in the stock market. Right. If you have $100,000 that you're going to go invest in the stock market, you're going to experience appreciation on $100,000.
That's very true.
If you're going to go buy a home for $500,000 and you're going to put $100,000 down, you get to experience appreciation on $500,000.
It makes so much sense. And I always talk to clients about trying to buy something that's not maybe at the peak of its potential. So there's still room. So if you buy a house that needs cosmetic work and you put the money in, you should have built-in equity. So that gives you a cushion if anything does shift. We give advice, but we don't know. We don't have a crystal ball. We can't predict the future. The best of the best can't 100% predict the future. So, we can only guess, educated guesses. Mm-hmm. But yeah, that's really interesting about the home equity line. It's something that I want to look more into. And then qualifications for that. Is it similar to a regular mortgage?
Most lenders, it is similar to a regular mortgage. There are some options out there in the market where it's a little more lax because that is a RESPA loan. It's more, even though it's leaned against your home, it's not considered the same as a primary first mortgage. It's not looked at from a compliance and regulatory standpoint in the same way.
Well, Justin, thank you so much for being on the show.
My pleasure,
It's
Sarah. I
been
really
great
appreciate
having
you
you.
having me. Yeah.
So for anyone that wants to get in touch with Justin or anyone on his team, if you have questions about mortgages, if you need to, you do refinances as well. Is that
We do
right?
refinance. Lots of people taking advantage of low rates over the past few months. We can help you with that, save you some money, figure out what your goals are going forward. If you want to save money on a monthly basis, would you like to shorten the term of your loan and get that house paid off sooner rather than later? We can do all of that. You can find us at www.LendLA.com. Very straightforward. And it's my cell phone number, so it's the same number that my mom calls me at.
That's amazing. And I have my same thing, cell phone number. And we'll also have that in the podcast notes. So if you didn't manage to jot that down, you'll be able to just click on the links. This has been the LA Real Estate Podcast. I'm your host, Sara Skelton, and we'll catch you on the next one.